Today we're looking at whether it's the turn of the yen to gain some strength. And then we're going to shift over to Barclays' recent call on actually January being the time for the Fed to hike another 25 basis points rather than December. And the trading takeout today is going to be on one of the unspoken about sort of rules to having a better trading psychology. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. We've had some chat coming out this morning from the Bank of Japan. Started off at about 105 this morning. And he's talking about the Japanese economy. This is Ueda, the governor of the Bank of Japan. Japanese economy is recovering moderately and is likely to continue recovering. It's quite hawkish. And you'll see from the other comments as well that it tends to be quite hawkish, which means, increase in interest rates. He says long-term rates may rise somewhat, but what's important to look at is the real interest rate that takes into account inflation expectations. Another key bit here is even if long-term rates come under upward pressure, he doesn't expect the 10-year JGB yield to sharply exceed 1%. If you'll notice last week, he expressed the Bank of Japan were looking at flexibility for their yield curve control policy. And this is what he says underneath as well. Need to carefully weigh the effect of the policy in stimulating the economy and the potential side effects under yield curve control. So the way that I'm taking this is very much short-term hawkish, because he says as well up here, if I can find it, this is the key bit. Bank of Japan Governor Ueda said BOJ need to have more conviction that wages will keep rising. Rising wages lead to service prices, and the economy remains strong, which leads to pondering an exit from easy policy. That's what the market has taken as a bit hawkish here. And you can see that dollar yen has sold off off the back of this, basically. We're seeing a weakening dollar versus a strengthening yen off the back of these comments. The market's obviously just woken up this morning and said, okay, well, we want to buy some yen here because we like these comments overnight. I don't think it's sufficient to cause a longer term decrease. I think what will happen is we will trade, if we go back to a bigger time frame, I reckon we should touch these two lows. We should test what the market is saying down here. And I think what Ueda is doing is quite clever here. He's effectively guiding the market down. I don't know if you recall a couple of months ago when Powell effectively did like a 10 basis point hike where he spoke about, tightening monetary policy, and that caused equities to sell off. I think that's similar to what Ueda's doing here. He's sort of doing a hike without saying it. He's talking about and teasing the market about easy monetary policy. Easy monetary policy. I think short term it's bullish yen. I like it. I think if you look at how we're forming here, even on the daily chart, that's a big bearish engulfing. I think we target down at this low 149.18, and then we continue on down to these lows down here. I don't know if we'll get this low, but definitely we should start hitting levels like here. You can see there were loads of buyers along here previously, so probably 149 is a specifically low place to be looking at interest in this market. But key to take away from this today is that they are looking at the extent to wage rises. Whether they will approach there depends on the next couple of months, and whether a global recession starts to really, really hit in. We are seeing data deteriorate. I think one thing that would be a dampener on this is that Japan is a massive energy importer. And so if energy prices do decline sufficiently because we aren't seeing demand at all, then that puts a bit of a water bucket on the idea of wages in Japan increasing, because they won't need to if energy price isn't increasing. So the big risk for yen strength over the longer term is energy prices increasing, in my view. We're not seeing that right now. So I think this is more of a short-term move than anything else. So you can see here that Barclays sees the Fed hiking rates by 25 basis points in January Previously in December, they expected this to occur. And the reasons are they're citing dovish Fed commentary and softer than expected jobs data. It's a strange one for me because if we go and look at this, which is the Fed funds futures term structure, it shows really that the market's not pricing anything for January. Here's January. It's saying that the increase in interest rates simply will not happen. So it's a very bizarre one for me, for even Barclays to be pricing it for December. But what I think this is showing is that the sell side research isn't sure. And instead of just pivoting and saying, oh, well, they're not going to hike now, what they're saying is, we think it's going to happen a month later. They're going to release a piece of research next month that says, we think it will happen in March. And it will go like this until they say, well, actually, because of global events, geopolitical changes, they have to pivot. So it will never be their own fault, basically. It's a very interesting one, though. And it's interesting from the perspective of, okay, what happens with stocks here then? So if you look at the ES, and now there's nothing really, meaning that it's down to Barclays or anything here, but the shift in how rates have repriced things is quite astounding. I mentioned last week this would be the area excuse me, that I would look to sell in. But in fact, I think we start ticking all the way up to 44.40 again. So we start getting all the way back up to here, because if you look in line with, where has my quick strike just gone? There we go. If you look in line with how rates are now priced, they're not going up, but the economy is ticking along. There's not been a meltdown. What is the path of least resistance? It's up for equities. If something drastic happens, then there's a cause for, the markets come plummeting down. But again, that just gives more rise to liquidity to come into the system because they want to maintain the status quo. I don't know what would ever break this market, quite frankly, because people are very, very happy just to keep buying. It is astounding, and it has been for, 10 odd years, 10, 15 years now. But there doesn't seem to be anything that really wants to break it considerably. People are happy just buying equities. Look at this move since the end of October. It's brilliant. It's fantastic, especially if you're passive. It just consistently keeps rewarding just holding US equities. Draw a trend line here. There could be some reason to start selling, perhaps, if that's your persuasion. But at the moment, nothing's really there. You could start looking at 44.30 to, as I said, 44.40. There's kind of an intersection there if you're looking at it from a technical analysis perspective. But it is a very strong move, to be fair. And so I'd look for some reversion at least. But who knows? Who knows? If rates keep getting priced out and Barclays and the other investment banks keep shifting their forecasts, then that just gives a massive, massive bid to equities, because there's nothing necessarily causing a meltdown. I think unemployment would have to slip hugely, but unemployment is in kind of like a Goldilocks period right now, where it's not bad, it's not missing hugely, it's not really soft at all, and unemployment's not ticking up. So it's a perfect position for the market. Rate hikes now aren't going to occur, I don't think. So market likes it. So why not keep going up? But anyway, that's my view there. I find it difficult to buy this market personally. I've had a couple of trades in it and they've gone all right. But I get very funny when you see parabolic moves like this. Like, this is insane. Like, this has been over the course of about 10 days or so. Ridiculous. Crazy move. But, I would look for risk up here, look for any sort of changes in market structure up here. If we start leveling out, that's when it's a little bit exhausted. So that's how I play it. Today's trading takeout is really quite an uncomfortable truth, and it is that if your account size is underfunded, there is no amount of psychology, no amount of fantastic signal or indicator to help you, and that's a fact. If you're trading with a $1,000 or £1,000 account, 1% of that is only $10 or $10. So if you do the, typical, oh yeah, let's make 2% with 1% risk, you're actually able to make 20 quid per trade. Is that at all any kind of incentive to keep going? Not really. So what happens, and you probably know this exact story, is that you over leverage, you start to lose more, then you try to revenge trade it, you then over leverage even more, and then by the time you know it, you're 500 quid down. And this is probably where Axie Select comes in really, really well, because firstly, rather than having to, risk your own capital necessarily, you're able to trade a much larger size. And with that comes the ability to be more free. It allows you to actually have the pressure off a bit and be able to transact and do business in a way that is actually trading rather than over risking and over gambling. So give it a try, because otherwise you're going to be stuck.